Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
And volatilities are at very, very high levels. If you take a look at this next slide, you'll see that euro-dollar 1 month volatilities are, which is the orange line and the blue line is the euro-dollar chart, is at the highest since February. And that is the highest since 2004. So volatilities are once again at double-digit levels. And if you take a look back at this euro-dollar chart, you'll see that what happens after we have a strong phase of volatility or strong jump in volatility. Well, it's a reversion to the mean. Most global macro hedge funds out there like to trade this sort of reversion to a mean scenario where what they're looking for is after sharp expansions in volatility, you have a contraction in volatility. So we see the sharp expansion in volatility similar to the move in February where we have the spike that's most recent. And look how volatility plunged from February all the way probably up to a month or two ago when volatility in the euro-dollar went from 12% all the way down to 8%. Volatility in the pound-dollar is hit even more significant levels. You can see in this chart here that volatility in the pound dollar has hit the highest level since 2003. It actually cracked the 2004 highs. So once again, what does this tell us? It tells us that when we have such a huge expansion of volatility, the next thing that we could expect is some sort of consolidation. And perhaps that may be what we're beginning to see now. Since the announcements on Monday of Fannie and Freddie, what we've been seeing is a slower grind lower in the euro dollar, in the pound dollar, in the Aussie dollar, in the Kiwi dollar. I think that even though the dollar will probably continue to rally, here on forward, the further gains in the dollar will come at a much slower pace. And we're beginning to see that manifest itself on a price level. We should see this manifest itself just because volatility, when it skyrockets to the levels that you see in this chart here, always reverts back to the mean. And when it reverts back to the mean, it means range trading for us as FX traders, as spot traders. Here we have a chart of the correlation between the yen and the CVIX. The CVIX, which is created by Deutsche Bank, which is why it's called the Deutsche Bank CVIX, is a basket of it's basically a basket of currency volatilities. And guess what? These are near mirror images of each other. The DB CVIX and dollar yen basically move in the same direction. And what this tells us is that dollar yen and the carry trades are indeed very, very much sensitive to volatility. So carry trades have plunged a lot because volatility has skyrocketed. If volatility starts to temper off and reverts back to the mean, then the sell-off in carry trades could begin to temper as well. So let's take a look at what happened and what basically drove the sharp rally in the US dollar. There are four primary things that happen. Number one is that the market these days is focusing much more on macro themes than it did on micro themes. I wish you guys were actually in the live room with me because, usually I like to talk to a live audience. But how many people here actually was watching the non-farm payrolls release on Friday? And, I'm hoping that many of you did. Non-farm payrolls, or the U.S. unemployment rate, hit a 5-year high of 6.1%. And the dollar sold off after the number, just like you would expect when you have a bad number. But guess what happened? It quickly recovered all of those losses and actually trended lower for the rest of the trading day. This tells us, or this confirms to us, that the market is indeed focusing on macro and not micro themes. When we talk about micro themes, it's more like, day-to-day economic data. When we talk about macro themes, it's what's going on, the big stories that you read in the front page news, which may not necessarily be about how ISM came out, but it's about the fact that we still have trouble in the banking sector. It's about the fact that oil prices are making headlines every single day. So macro versus micro themes is what's driving the markets these days. Number 2 is the reversal in crude prices. This is the chart illustrating, and this chart I took just at the beginning of this week, and oil prices have fallen even further since then. But in a very short period of time, we have basically erased close to 75% of the year, or 80% here, it says, year-to-date gains in oil prices. Oil, in the beginning of the year, was trading at about $95 a barrel. Shot all the way up to $147 a barrel in July, and has now pulled back, at least 30%, has now basically fallen at least 30% off of its highs to close the day at $102 a barrel. $100 a barrel, I was calling for this, when oil was at $120. Now is within a whisker, within only $2 of the current price. And this is the answer to the problems for not only the U.S. central bank, but for central banks around the world. Because what was the primary catalyst for the global slowdown is skyrocketing. Rising is an understatement. Skyrocketing prices. We have skyrocketing prices in many soft commodities, as well as many other things that we talk about. And the fact that oil prices have fallen so much is certainly going to help to ease a lot of those inflationary pressures. We're already beginning to see central banks around the world become more comfortable with cutting interest rates. The RBA cut interest rates last week. The RBNZ is expected to cut interest rates tomorrow. And the ECB, the Bank of England, will probably follow suit soon. So the fact that oil prices have come down and inflationary pressures have eased, what this has basically done is it's led to an environment where central bankers no longer need to obsess with themselves with stabilizing prices. What they can now focus on is actually working on boosting growth. And I think that that's really going to be a big predominant theme going forward. For the U.S., we're actually, this is actually a really good thing, because not only do we have oil prices falling, reducing inflationary pressures, but the stronger dollar also in of itself reduces inflationary pressures. So we have two things that are driving prices lower. And these two things driving prices lower could be what sort of helps the U.S. economy turn around, helps U.S. consumers feel more comfortable with maybe spending this holiday season. Yes, we still have problems in the labor market. And yes, we still will get more trouble in the banking sector. But at least from one perspective, which is the price and discretionary income perspective, there may be a little bit more breathing room. And just because of that, we could have some sort of stability in the U.S. economy going forward. So this next, number 3, the third theme is interest rates, which I'll touch on later. And the fourth driver is risk aversion.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.